A perfect storm just slammed into the Indian markets. We're talking about a brutal sell-off, a crisis in one of its most important industries, and now Wall Street is sounding the alarm. So let's get into it and unpack the historic week that has everybody asking one big question. Is India's tech-fueled growth story broken?
This is where the story starts. Negative 5.29%. That was the staggering one-day plunge of the Nifty IT index, which, tracks India's top tech companies. People are calling it a Black Friday for Indian tech, a real day of reckoning that sent shockwaves through the whole system. But as bad as this looks, believe it or not, it's just the tip of the iceberg.
And yeah, the pain was pretty much everywhere. You can see India's main indexes, the Sensex and the Nifty 50, both took a decent hit. But just look at that IT bar. It's not even close. It's a total collapse. The sell-off was broad, for sure, but the IT sector was, without a doubt, the epicenter of this earthquake. It was actually its worst week in 6 years.
So what lit the fuse on this thing, right? What caused this sudden, massive wave of panic? Well, the immediate trigger, the very first domino to fall, was a classic: company earnings.
The whole rout was led by the biggest names in the business. We're talking Infosys, HCLTech, TCS. They all just plummeted. Why? Because they released some really disappointing forecasts for the year ahead. For Tata Consultancy Services, it was especially brutal. They reported their first annual revenue dip in over 20 years. The message from the top was loud and clear: rough seas ahead.
But here's the thing. A weak forecast is really just a symptom. Underneath all this, there's a much deeper, more fundamental crisis brewing. This isn't just about a bad quarter. This is about a massive, structural shift. And right at the center of it is the biggest force reshaping our world right now: artificial intelligence.
So what is it about AI that has investors so freaked out that they're just dumping shares of these legendary companies? What's the existential threat that they're suddenly seeing on the horizon?
This right here is the absolute heart of the matter. For decades, the Indian IT success story was built on a really simple formula: hire more engineers, make more money. Well, that model, it's officially broken. Clients just aren't paying for headcount anymore. They want outcomes, they want efficiency, they want results, and AI is completely rewriting the rules on how you deliver that value.
And if you need proof, just look at the hiring data. For the first time in years, India's top 5 IT firms collectively cut jobs in fiscal year 2026. We're talking almost 7,000 roles. Poof, gone. This isn't just a normal downturn, This is a fundamental recalibration. It really looks like the era of mass hiring is coming to an end.
And listen, don't just take my word for it. This quote from Phil First at HFS Research just nails it. He says the job cuts aren't just about a slowdown. It's because AI is changing what he calls delivery economics. That's just a fancy way of saying the whole business model is being flipped on its head. Clients are buying results now, results delivered by people and AI, not just paying for an army of coders. And if you want a really powerful, real-world example of this disruption, just look at this thing called Mythos. It's a new AI from Anthropic that can literally hack complex software all by itself. It's so potent that India's own finance minister has been holding high-level meetings telling banks they need to get ready for this AI-born challenge. This is the kind of stuff that's forcing every single company to rethink everything. Okay, so let's zoom out for a second, because this whole tech crisis, it's not happening in a bubble. At the exact same time India's IT sector is having this internal meltdown, some of the biggest and most powerful names on Wall Street are starting to get really nervous about the entire Indian economy. On April 24th, JP Morgan, a huge name, downgraded Indian stocks from overweight all the way down to neutral. That's a big deal, and they laid out 4 key reasons why. Then, right after them, HSBC did pretty much the same thing. So, when these giant global banks start sending up red flags like this, you have to pay attention.
So reason number 1, valuations. Even after this big drop, JP Morgan is basically saying Indian stocks are just too expensive. Global investors are looking at a 65% premium. That means stocks in India are priced way higher than similar companies in other emerging markets. And they're starting to think, you know what, I can get a better deal somewhere else, like Korea or Taiwan.
Reason number 2 is the energy shock. Get this. India imports a mind-boggling 88.6% of its crude oil. So with all the tension in the Middle East pushing oil consistently over $100 a barrel, corporate profits and the whole economy are facing a massive headwind. Now, this chart is fascinating. It really shows what JP Morgan calls the AI exposure gap. See, while markets like Taiwan are absolutely booming from selling the picks and shovels of the AI gold rush, semiconductors, India's main stock index has zero, literally zero exposure to that crucial hardware sector. All its tech weight is in the services companies that are now getting squeezed by AI. It's a huge structural problem.
Okay, so when you start putting all these pieces together, you've got the earnings shock, the AI disruption, the Wall Street downgrades, it becomes pretty clear that this is way more than just a market correction. This feels like a pivotal moment, a real economic crossroads for India. And that's really the bottom line here. The pain we're seeing in the stock market isn't just random noise. It's a signal. It's the market's way of forcing a really painful, but probably necessary, transition away from an old economic model that has just run its course. It's time for something new, something that can actually compete in the age of AI.
And that just leaves us with the big, multi-trillion-dollar question. This whole tech shock has exposed some pretty deep fractures in the economy. As AI keeps changing, well, everything, the challenge now is to adapt, to innovate, and to find brand new engines for growth. The question isn't if a new model is needed anymore, but who's going to be the one to build it.
If you want to keep following how this massive story develops and get more explainers on the big forces reshaping our economy, do us a huge favor and make sure to like, share, and subscribe. And hey, we really want to hear from you. What's the next complex topic we should break down like this? Let us know in the comments below. Thanks for watching.